In this video, I show you what the RSI indicator does and why most traders completely use it in the wrong way. So what is the RSI indicator and what does it do? So the RSI indicator stands for relative strength, which is important to note. It is a momentum indicator. It shows you how strong a certain price move is. That is what momentum does usually. It shows you the acceleration and it shows you the speed and the strength of a trending phase. It compares the bullish and the bearish candles, which we will see in a moment. It also compares the size. So I will show you this in the next slide. It doesn't do overbought, oversold. This is the biggest myth that most traders or almost all traders get completely wrong. So when the RSI indicator is very high or very low, this is not an indication that the market is going to reverse. It is quite the opposite, as we will see. So I said that the RSI indicator compares the bullish and the bearish candles, and this is exactly what it does. So the default setting is usually set to 14 periods. And what this means is that the RSI indicator looks at the past 14 candles. So in this example, you can see I made a box around 14 candles. And within this box, there are almost only white bullish candles. There's only 1, 2, 1.5 bearish candles. And obviously, this shows us that, well, out of 14 candles, 12 are bullish. And also the bullish candles are quite large. The bearish one is very, very small. And this then leads to a very high RSI indicator. And this is a very first important thing that you need to understand. Here are a few more examples. So in this box, out of those 14 candles, there is only 2 bullish candles and the rest is bearish. So a very, very, very bearish trending phase. And this leads then to the RSI going down all the way to a 17 ratio. The RSI will go between 0 and 100. And if the RSI goes to 100, it means that there are only bullish candles, and the bullish candles are very big. There are almost no wicks, and they're only pushing in one direction. If the RSI goes to 0, it means that there are only bearish candles, and the bearish candles are very large and have no wicks. Here, a different example. In this box, there are still almost only or mostly bullish white candles. However, there's 1, 2, 3, 4, 5 bearish candles. So it's almost 50-50, not quite, and that's why the RSI is at 70. Here in this example, we have half-half. We have 1, 2, 3, 4, 5, 6. So not quite half. We have 6 bullish candles and 8 bearish candles, and this means that we have slightly more bearish candles, and that's why the RSI is slightly below 50. It's at 42. If you would have half bullish, half bearish, and the candles were roughly in the same size, then the RSI would be at 50 flat. Here another example of how the RSI, or a first example of how the RSI is used to describe trending strength. You can see that the market came here on the left from a downtrend. It bottomed out, and then here the bullish trend started. And here was really where the RSI started picking up. Why? Because here suddenly we have a series of bullish candles. 1, 2, 3, 4, 5 bullish candles. And this leads then the RSI to get over 50 here eventually. And then during the uptrend, you can see the RSI also makes higher highs and higher lows, which indicates that the bearish candles are not that many in the count. And they are mostly bullish candles, which we can see, and this is what the RSI then also confirms you. And then here at the top, the market topped out, and then here once the market broke into a new low, that is also when the RSI broke down. And you can see we can draw trend lines on an RSI, and when a trend line is broken, it tells us that the trend structure has changed as well. And then here you can see the RSI goes all the way below 20. Why? Because here we have almost only bearish candles. There are a few, or at least just one small bullish candles. We have a few wicks, which means that the RSI won't go all the way to 0, but it's very, very bearish. And then again, the RSI turns around, the RSI breaks this trend line that we can draw here, and then also the market changes. Here we can see that I drew a trend line, or more or less a horizontal line at the 50 level, and the 50 level is like a tiebreaker. If the RSI is above 50, it means you have more bullish candles. If the RSI is below 50, you have more bearish candles. And here you can see that the market was here in a slight uptrend, not that meaningful, but the RSI was quite high because in this region we almost only had bullish candles. And then here the RSI accelerated. It moved all the way from over 70 to below 50, and then indicated this trend along with staying below this moving average. Then the trend accelerated. It continued while the RSI was always below 50. It was even often below 30, which is an important threshold. And then the market eventually topped out. Here the market broke above the moving average, and that was also when the RSI came very close to 50, and then you can see it just faded out. The most important point, not the most important I would say, but a very important point, how you avoid misunderstandings with your indicator. Look at the formula and then try to understand what the formula is telling you. I see so many traders always saying, okay, the RSI is an oversold, in overbought, let's get ready to sell. And this is one of the most, well, it's the dumbest thing you can ever do almost. There are many dumb things in trading, but this is very close to the top. Because what have we seen previously is that if the RSI is high, it means that there are a lot of bullish candles and that there are not a lot of bearish candles. So does this really tell you that the market is ready to reverse? Or maybe it would tell you that the market is in a very, very strong trending phase and there are not many signs that the market is reversing. So you can see that here. The market was in a very strong uptrend. The RSI was here well above 70, and here as well for a long, long time. And the market kept climbing and climbing higher. People who sell once the RSI gets too overbought, they will end up losing their account. This is almost a guarantee that I can give you, because this is exactly the opposite of what the RSI is telling you. The RSI is not telling you it's overbought, it's time to sell. No, it's overbought because the market is just very, very strong. Here another example, and this is so important, just put it on your chart and observe it. When you're in a strong trend, the RSI is either in the bottom or in the upper end, because that's what the RSI does. It shows you strength or it shows you weakness. It doesn't mean that the market is going to reverse. The RSI has 0 components in its formula that would indicate a reversal. It's a pure trend strength indicator. Here, what we can do also with the RSI, which is nice if you have an established support or resistance, like in this case, you wait for a move back into the resistance and then you look for a breakout when the RSI is very, very high. So you can see here the price moved multiple times into the resistance. Here the RSI was roughly at 55, here it was at 61, 68, but it wasn't until the market was above 74 that the market actually broke out. So in this case, then you can see if there are a lot of bullish candles, if the bullish candles are large, then a breakout is likely to succeed because you're trading with the momentum. You're not trading against it, you're trading with the momentum. And this is a very, very powerful way of using the RSI. And last but not least, one of my favorite ways to use the RSI is look for fading strength. And this is how you can use the RSI to time reversals and trades into a new direction, not based on overbought and oversold, but based on what the RSI is telling you. So let's look at the RSI and try to understand what does it tell us. Here the market was in a very strong uptrend, almost no bearish candles. You can see that the RSI almost rose to 80, and then you can see that here again less strong and less strong. And what does happen now is that here you can see this leg compared to this trend compare this one to this one. Obviously the angle is much shallower, the price doesn't rise as fast. Here you can also suddenly see that there are more bearish candles and the bearish candles are larger compared to in this trend leg. We only have one bearish candle, the rest is just going upwards all the time. And here suddenly we have more, and this gets even more pronounced when the market is moving here into this top. The market has a very hard time rallying higher. There are more and more bearish candles, And the RSI indicates that the RSI is not making higher highs anymore. And the RSI is doing something that we call a divergence. A divergence is when the market and the price action and the indicator is not agreeing. So here you can see the price was going higher, RSI was going higher. Here you can see the price is going higher, but the RSI is not going higher anymore. And this shows us that now we are actually losing strength, and this is a sign that the market may be ready to reverse. And this is actually a trade that I am going to trade once it moves lower, and this is something that is happening actually right now as we speak, and we could have anticipated it. Here more examples of divergences. I think they are very well worth studying. Not only with an RSI, you can pretty much use divergences on any momentum indicator, stochastics, MACDs, whatever you may prefer. And what does it tell us? Again, here a very strong trending phase, very strong move. You can see that the price within a short period of time, it rises very quickly. And here the RSI makes a very big high. And then the next time here, the market barely breaks above the previous highs. We don't have a series of large, big bullish candles. And this is then confirmed by the RSI making lower highs. We have more bearish candles, and then shortly after the market reverses. And here exactly the same thing, very strong bearish market trending phase. The RSI dipped roughly below 20 here, just barely below 20. Then here on the next trending phase, the market barely makes a new low. We have more bullish candles, and the bearish candles are not as strong and not that many. So the RSI is showing us that as well. The market is not as weak anymore. And then you can see that what happens afterwards is a new trending phase. And this is really how you use the RSI. And yeah, this is why the RSI can be such an interesting, powerful indicator that can really improve the way you look at charts.